Last week was a pretty interesting week for semiconductor stocks and semiconductor investors, right? Because one day you've got ASML reporting, stock goes down, takes the whole industry with it. Then the next day you've got TSMC reporting a pretty good report, good guidance, good commentary, stock goes up, and then you see a small recovery for certain semiconductor stocks. So yeah, let's discuss both companies, both results. I'll share my opinion on both of those companies and stocks. Of course, if you are a follower, a subscriber of the channel, you know that I did release a video just before ASML reported, and it's a video that basically said stock to buy when the market dips. One of the two stocks was ASML. Now, I did not know that ASML would release their quarterly results early, so that's not on me. But the point of that video was basically to say that ASML is a very, very strong company, stable company as well. And if the market dips, well, in this case, the market didn't really dip, it's just ASML that did dip, I think there could be a great opportunity. Did that opportunity already arrive? We'll discuss that in this video. Of course, do share your thoughts down in the comment section below. Like, subscribe, do all of that. We really appreciate it. And if you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's start with company number one here, in that TSMC, or Taiwan Semiconductor Manufacturing Company Limited. Has a market cap of $877.3 billion, a forward PE of 19.7 times. The performance of the stock in the last 5 years is basically this. It's up 336%. Year over year, it's up 123%. And year to date, it's up 94.7%. Now, this is a company that is already huge. It's very, very important for, well, the world, to be honest. And it's still expected to grow quite quickly. If you look at the analyst estimates here for the next coming fiscal years, top and bottom lines still expected to grow quite fast. And to be honest, if you're looking for a pure play semiconductor AI play, right, I think you cannot go wrong with TSMC, because most, if not all, of the big companies need this company, right? Without it, well, you're not really getting the best of the best chips out there. Yes, Intel is trying to compete, but let's be honest, I think it's going to take quite a while until Intel reaches the level of TSM. If we currently look at some pricing metrics, so forward PE, EV to EBITDA, price to sales, price to free cash flow, and price earnings to growth, you can see that it's not that expensive, right, compared to its 5-year mean. Even with the stock's performance, right, even with the fact that this stock is up close to 100% year to date, it's really not that expensive, right, from a pricing perspective, because the business has accelerated and has continued to grow at a fast pace. I mean, if you look at price earnings to growth, it's under 1. Usually anything under 1 is considered, let's say, undervalued. Now we can already compare it to ASML, for example. And as you can see, ASML on all of those metrics, but price to sales is more expensive than TSMC. Of course, you're going to see why right now TSMC is performing much better than ASML. All right, so TSMC basically beat across the board for the quarter and for next quarter guidance as well. This is a great summary by Brad Freeman, Stock Market Nerd on X. A great follow, provides a lot of free information. So I highly suggest you go follow him, and this is not sponsored or anything. Now, as for the quarter, net revenue came in at $23.5 billion above their own guidance. Gross margin came in above their own guidance as well at 57.8%. Operating margin 47.5%, also above the guidance. And then net profit margin at 42.8% with a return on equity of 33.4%, which is up 6.7 percentage points over Q2 and 7.6 percentage points year over year. So yes, it's safe to say that this company is firing on all cylinders. If we're looking at the revenue by technology, we can see that 3 nanometers is taking more and more share of the revenue. 5 nanometers sits at 32%, 7 at 17, 3 at 20 right now. And look at this last year, same quarter last year, 3 nanometers was a tiny portion of revenue. And just a little reminder, this is basically the beauty of running a good foundry business, because even the older technologies are still generating revenue for the business today. This is what I've been saying also with Intel. The older technologies, all the investments that they're making, it's not like, oh, it's an old technology, we're not going to make any money on them 5-10 years from now. No, you're still going to be able to generate revenue from that. And so the return on your investment should be, well, could be much, much better, right? If you run a very, very good foundry business. As for Q4 guidance, they expect revenue to be between $26.1 to $26.9 billion, and that was a 6% beat. Gross profit margin to be between 57 to 59%, and operating profit margin to be between 46.5 to 48.5%. Now, if we go and have a look at what the CEO has said with regards to CapEx, so they now expect their 2024 CapEx to be slightly higher than $30 billion. Between 70 to 80% of the capital budget will be allocated for advanced process technologies. For TSMC, a higher level of capital expenditures is always going to be related with higher growth opportunities in the coming years. And as long as our growth outlook remains strong, we will continue to invest. So it is very likely that our CapEx next year will be higher than this year. And of course, you don't do that if you don't expect continued growth. Now, this is basically TSMC, or what has happened with TSMC's business from revenue and free cash flow perspective, and then what is expected in fiscal 24, 25, and 2026. And so if we go and look at our trusted reverse DCF sheet here, we plug in the numbers for TSM, we plug in the trailing 12 months free cash flow, terminal growth rate, discount rate, and then we get this. So the implied growth rate to justify today's price sits at 6.1%. Basically, they have to grow free cash flow 6.1 or 6.13% for the next 10 years to justify today's price. And as we've seen, it's expected to grow faster than that. Now, of course, this is for the next 10 years. We can only see for the next 2 fiscal years, or 2.5 fiscal years. So, yeah, I mean, is it expensive? Is it crazy to say that we think they can grow it faster than this? Even closer to, let's say, 10% or so? If we say 10%, then yeah, the upside is 36.31%. So yeah, I mean, it's a very, very strong company. But of course, there's always risk, right? The risk is it's on an island near China. So yeah, that's the big risk. And let's be honest, if anything happens with Taiwan, it's not just TSM that's going to feel it. It's basically everyone. So yeah, TSM still an incredible company. They are building out a foundry in the United States as well. You know, diversification, it's pretty important. Now, moving on to company number 2, and that's ASML, also feeling the heat a little bit, or feeling the heat from the China export rules, right? So let's look at ASML right now. ASML year to date is down close to 4%, has a market cap of $283.7 billion, and here the forward PE is a bit higher at 28.3 times. Now, ASML in the last 3 years, stock is actually down 6%. In the last 5 years, stock is up closer to 200%. Now here, what are the analysts expecting? Well, for fiscal 2024, basically revenue to be flat. So no surprises there, because we've heard management talk about that, and EPS to be down 6.11%. Then moving into fiscal 25 and 26, well, revenue to grow 15-16% year over year, and EPS closer to 29-24% for fiscal 25 and fiscal 2026. Looking at the current average analyst price target, and of course that has come down, still sits 32% higher than the price we're at today. Then looking at some pricing metrics, of course this comes after the stock has dropped by around 10-11% or so. It is now back under the 5-year mean. When you look at forward PE, EV to EBITDA, price to sales, it's still above by quite a lot. If you look at price to free cash flow, that's in the last 12 months. Then if you look at price earnings to growth, sits at 1.43, which is not the cheapest that we've seen, but definitely not expensive. Now, what was the issue for ASML? Let's look at that report. So this is basically the major overview again from Brad Freeman on X. For the quarter, close to a beat across the board, they sharply missed bookings by 51%. As for guidance, well, for Q4, that's fine-ish. But if you look at 2025, so they lowered 2025 revenue guide by 7%, which missed by 9.5%. They also lowered 2025 gross profit margin guide by 52%, which missed by 230 basis points. So yeah, not great. So the CEO said the following: while there continue to be strong developments and upside potential in AI, other market segments are taking longer to recover. It now appears the recovery is more gradual than previously expected. This is expected to continue in 2025, which is leading to customer cautiousness. Regarding logic, the competitive foundry dynamic have resulted in a slower ramp of new nodes at certain customers, leading to several fab pushouts and resulting changes in litho demand timing, in particular EUV. In memory, we see limited capacity additions, with the focus still on technology transitions supporting HBM and DDR5 AI-related demand. They're talking about Samsung and Intel, among others. So, the Q3 numbers were as follows. Total net sales of 7.5 billion euros, net system sales of 5.9 billion euros, gross margin of 50.8%, operating margins 32.7%, net income as a percentage of total net sales was 27.8%, earnings per share basic 5.28 euros, net bookings of just 2.6 billion euros, including EV bookings of 1.4 billion euros. Now, if you look, and this is basically the issue, right? If you look at net system sales breakdown quarterly, China 47%, last quarter that was 49%, Taiwan 15%, USA 21%, so yeah, much more than previously. But China being 47%, seeing how there are some restrictions, right? Export restrictions, it's probably starting to hurt the business. Looking at what the company expects for Q4, they expect total net sales between 8.8 to 9.2 billion euros, gross margin between 49 to 50%, and then for 2024, the expected total net sales of around 28 billion euros with a gross margin of around 50.6%. So yeah, remains a little bit unchanged as we've seen previously. So zooming out a little bit and looking at the performance of the business, total revenue, free cash flow, gross profit, it grew, right? It grew in the last 4 years, but more recently it has been stagnating, right? We know Q4 is usually the strongest quarter. I mean, you can see it quite clearly, right? Every Q4, you can see gross profit, free cash flow being much higher than the previous quarters. But now, of course, the expectation was that exiting 2024, going to 2025, overall, things should reaccelerate. Now, that's not the case. And so currently the expectations for fiscal 25 and 2026, well, fiscal 25 revenue is expected to grow 16.3%. Free cash flow is expected to be much higher, right, than 2024 at $7.85 billion. 2024, it's expected to be just above $4 billion. If you look at 2026, revenue is expected to grow another 15.1% and free cash flow reaching $10.63 billion. And so now we can basically plug in the numbers here. So free cash flow trading 12 months, $2.871 billion. This is the terminal growth rate, 4.08%. The discount rate, 8.04%. And so the implied growth rate for the next 10 years is 20.7% to justify today's price. Now, yeah, we know that the expectations for revenue is to grow, 16% for the next 2 years. So that's what we know right now. We also know that there are still uncertainties going into 2025. Previously, they expected 2025 to be much better, right? That's why guidance for 2025 was such a big miss. So yeah, you are paying a premium. That's what I said previously as well. You are paying a premium. You will always pay a premium for these types of companies because, well, it's basically a monopoly, very, very important company. But because of the restrictions and because of the uncertainty coming up, yeah, maybe you do not want to pay that much more than previously. Now you're going to say, oh, how did you change your mind so quickly? Well, I changed my mind because I got extra information from the company, which previously I did not have, because previously I was still expecting 2025 to be better, much better than 2024. Now, that's not the case anymore. And so, looking at the stock right now, of course, we've got that huge red candle on the weekly, rejection at the 200-day moving average, and now we're a bit in no man's land, right? Yes, there is this, let's say, support-ish at around $740 or so, which we are lower than that. So let's see if in the coming weeks we can have a green candle and rebound above that. If not, well, if not, look down lower, right? Could be around 700 or so. And if that doesn't hold, then yeah, maybe it can make its way to 600. Then, of course, that becomes very, very interesting, and probably RSI will be oversold. Now, the flip side, the other scenario, the, let's say, bullish scenario, is that the market is looking at this and saying, look, this is a very unique company. We are willing to pay a premium for that. We know that this company is not going anywhere. We might also think that the export restrictions might be lifted after the election, new president coming in, dealing with China in a different way. Also, depending on what China will do with Taiwan. There is a lot of uncertainty, and because of that uncertainty, I would still stay on the sidelines. So yes, a bit of a switch here from what I said in the previous video. Yes, we have that dip right now, but we also have some more uncertainty. And that's something the market doesn't like, and probably most investors don't like either. So that's basically my thought. Two great companies, but I think that one company is in a much, much better position right now, which is TSM, than ASML because of the uncertainty. But of course, both of them have the same problem, and that's the China risk, the China problem. Over the long run, both great stocks to hold in your portfolio, but hey, be patient, look for more information, for more opportunities. That's basically my message here. Maybe I'm wrong, maybe I can't time the market, probably I can't time the market, but that's completely fine. Do share your thoughts down in the comment section below, like, subscribe, do all of that, and I'll see you all in the next one. Bye bye.